Atocha Global Analytics. Please like and subscribe.
Hello all, KT from Atocha Global Analytics. I wanted to take an opportunity to do something a little bit different here. I wanted to do a video that is a case study that focuses on commercial real estate. Consider this, is the past crash also a coming attraction of what we expect to foresee? And just to set this up, my name is Kevin, and I've been in commercial real estate and financial modeling, real estate acquisitions for about 3 decades. I was in the military. I was in the Army. I was merit selected to a staff position at West Point when I was in the Army. After I got out of the Army, I went into real estate appraising. And I actually owned a real estate appraisal firm for a number of years. I was in appraising for about 15 years. I did primarily commercial specialized properties. I also did some high-end residential, did a lot of expert witness testimony. After that, I moved into real estate acquisitions. Started in multifamily. I've modeled about $200 billion of real estate in my career thus far. And this case study, I actually appraised the property back in I think it was early 2007, and it was before we had seen any noteworthy declines in the commercial real estate market. And this was a small 2-unit 4,000 square foot office property. And so I wanted to use the financials that I initially got from that, supplemented with information I later got from the managing broker, because it was an acquaintance of mine from the local real estate market. But I would use this as a comparable. I knew the property, and so it made sense to use it as a comparable. So here's a video. It's topical because it's what's happening right now and likely what's going to happen in commercial real estate. It's a historical case study. Literally it is showing how the financials change, the cash flows within the property, etc. And I'm structuring the cash flows so that it's easy to understand. It's really the real estate related cash flows. It doesn't matter who pays them. It's just basically the cash flows and how that evolved. And they used a little bit of camouflage, shall we say, in how they approached lowering the net cost to the tenant or prospective tenant as an incentive to lease the property as competition increased because vacancy was increasing. So I want to show how the effective rents and the terms changed to evolve, and how it impacted things before prices. But before I do that, what I really need to do is explain how commercial leases work in case there's any of you that aren't familiar with that. There are some inherent structural aspects to how commercial property is leased and how it's described and communicated that needs to be expressed so that as the rest of this unfolds, it makes sense. So I'll see you on the other side of that.
Okay, as the media and other so-called experts have now realized the potential threat posed by the revaluation of commercial real estate after the Fed dramatically increased interest rates during the last year, let's examine a case study that highlights what happened during and because of the Great Financial Crisis and Great Recession to see how an office property performed during a crisis like the one we foresee coming at us now. When the Great Financial Crisis set in, it was before I began sourcing real estate assets and doing acquisition modeling. At the time, I owned a company specializing in appraising large and unique commercial properties. I happened to also do a lot of expert witness testimony work during this time frame, and one property I appraised for an attorney friend of mine was a 4,000 square foot, 2-unit office building managed by a local broker that I had a good rapport with. Here, I'm going to show you the breakdown of the financials on that property. Plus, I'll show you how the broker channeled renting the space within the declining market in the years before the real estate recovery began in earnest. But first, let's cover how commercial leasing works for those that may not know. The terms gross and triple net may not be familiar to some of you, so here's a table to indicate how commercial rents work. In these 4 columns, the lease structure is described in the left column. The next 2 columns show what party pays what, and lastly, how the expenses skew is to the right. Excluded from the table is CAM, which stands for Common Area Maintenance, which is an umbrella term that some of the costs noted on the table are included in. For simplicity, I've just expressed the expenses so things are straightforward and not complicated with more esoteric breakdowns. A quick note about triple net. The owner-landlord still has to pay financing costs and replacement reserves under that structure. For those that aren't familiar with the leasing terms, I want to highlight two that were used. If you hear gross, you need to think that the landlord is paying several or most of the items, the expenses. If you hear single net, the tenant pays a single category of expenses, double is 2, and with triple the tenant pays 3. Even if it's new to you, the terms are pretty logically defined.
Okay, so that's how leases work. So here's info on the property as I appraised it near the top of the market in the last cycle. As I mentioned, I knew the listing agent for the property when I appraised it. I knew the listing agent when it was subsequently vacant and had to be leased again, and the terms changed for new tenants and that sort of thing. And it's just an observation of how the market was really effectively dealing with it. So I'm going to show you the list of cash flows here and how these things evolved over the course of several years, and then you should have a good understanding of how these things shifted and how it'll probably apply in the future. So voila.
I've structured the finances here to show items as cash flows associated with the property. The rental income collected by the landlord is expressed here as $20 per square foot, which is the annualized base rent divided by the square footage that's leased. And the expenses could be paid either by the tenant or landlord depending on how the lease is structured. So when you take all these line items, annualize them, and divide them by the building square footage, or the lease, in this case, it's also the leased square footage, you get $38.60 per square foot. The base rent, or the rent that the tenant pays the landlord, may only be $20 per square foot, but everything else, excluding financing and replacement reserves, equates to another $18.60 per square foot. With the triple net structure, the tenant pays $32.60 per square foot. That's $20 per square foot plus another $12.60. And the landlord received the base rent of $20 per square foot and paid financing costs and replacement reserves out of that. That's the structure and the income and expenses circa 2007 for this property. Now, just to expand on how the different structures look, I've shown here how these expenses might shift around depending on how the parties might structure a lease. Absolute gross means the base rent is all the tenant pays, and with modified gross, they also end up paying utilities. The table proceeds to the right where the effective cost to the tenant goes up with each incrementally to a maximum of $32.60 per square foot with the triple net term. $32.60 is the annualized cost of all those items divided by the lease square footage. I've excluded replacement reserves here as it is almost always paid by the landlord or owner and would not be a factor in lease terms. Similarly, financing costs are not included in any of this because the landlord or owner always pays that as well. So here's the insightful part about the way things were handled during the Great Financial Crisis. As vacancy increased and landlords or managers had to make concessions to lease up their empty space, they started being creative in how they conceded. They offered 3 months of rent to start with, but it wasn't good enough for very long. Soon they were forced to change the structure and start to pay the property expenses the tenants had been paying previously. That's what the broker did with this property, and it was very common. Everybody was having to do it. Starting in 2007, the tenant in this property, renting both units, was paying rent and the triple net expenses, or $32.60 per square foot in this case study example. By 2011, the space had become vacant and was rented again to two tenants at $18 a square foot for each unit. But it was now modified gross, with the tenants paying base rent and utilities only. Note that the base rent, which is the advertised rental rate, only went down 10%. I'd say 10% doesn't look like much, but here's the huge caveat. The landlord was now collecting $18 per square foot, but paying an additional $10.20 in expenses that they hadn't been paying before. This means the landlord only got about 24% of what they had been getting just 7 years prior. Remember, the owner still had to cover reserves and financing costs, so they were basically losing money for a few years during and after the Great Recession. I show this as a case study of how it all happened before, because despite what the policymakers are telling us, we are seeing all the same storm clouds forming again.
Okay, so that's how it went down last cycle. Now, I wanted to highlight, this is probably very similar to how it may unfold in this cycle. The timing may be different. The specifics on how things are done may be some nuance of difference, but the main premise is they really don't want to change that headline number before they have to. Okay, so all right, so it's probably going to be similar to cycle, but nothing is guaranteed. But go ahead and look at these numbers, and I'll see you on the other side of these.
Now let's fast forward to 2023. Some areas of the U.S. are doing nearly the same as a few years ago, while others are really showing signs of strain. New York City, for example, has around 50% vacancy in their office buildings, and it's actually similar in a number of other cities. So that really looks like a potential disaster brewing. However, not every area is shockingly challenged right now. An area that I happen to be familiar with, Atlanta, is a bit in the middle. So I'm showing an example of a property from that market. So before the shutdown in 2020, the vacancy rate was a tad under 10% in Atlanta. And now in 2022, the most recent year with data, it's risen to 20%. That's a bit of a change, but not too bad when compared to New York City. Here's a concise breakdown of a 10,000 square foot office building's financials that I happen to be able to source. You can see the base rent was $23 per square foot. When the expenses are deducted, the net operating income, or the income prior to paying for any financing, and what we've commonly abbreviated as NOI in the industry, is just under half of what the property made in gross rents. Also, the property was rented triple net, with noteworthy costs being paid by the tenants. So the owner also had that benefit to the property's income. One note here is management. I noted that the 10% seems somewhat high for the market, and I dug around a bit to confirm that the owner also owns the management company that is managing the property, and it's likely that he's paying the, quote, owner's management company, which is also known as themselves, an above market rate as a strategic move. All right, so fast forward to 2022. The base rent and the rest of the financials remain the same, but vacancy in 2022 in the Atlanta metro is up to 20% now. So the NOI is down 16.3%. This is critical because when you value real estate via what's called the income capitalization approach, commonly called simply the income approach, you divide the NOI by a capitalization rate to estimate the value. If NOI declines, then the property's value via that approach is also declined. If we fast forward to what it might look like in 2024, with a recession and financing challenges on the horizon, and the decline would logically get even more pronounced. Just like the 2007 to 2014 case study we just looked at, we'll likely see the headline price per square foot stay high for as long as possible, but the vacancy rate they must model it with goes up, as vacancy will almost certainly increase during a recession. At a projected 25%, which is only 5% higher than 2022, that is likely a bit conservative for potentially 18 months in the future and in a severe recession, but I don't want this to be a worst case scenario. So the base rent, less 25% vacancy and collection losses, further erodes the income. Again, to remain consistent with the case study, the potential lease in 2024 might only be a double net lease. So one item was added as a cash flow expense in order to reflect this transition. Based on the new model and all other expenses remaining the same, including maintaining the same basic reserve replacement, the NOI drops another 36.8% from 2022. That's a cumulative decline of 47.1% overall from 2020 to 2024. However, that's not all that's happening to impact values. I mentioned capitalization rates or cap rates. They have been impacted from 2020 to 2022. Even if you were making the same NOI, the capitalization rate has adversely impacted values by 6.52% within the calendar year 2022 alone. That means that the value via the income approach, which lenders, owners, and regulators all care about, is down from 2.2 million to 1.6 million from 2020 to 2022. That's just 2 years. That means the 16% in NOI decline is really a 27% decline in value. If we extrapolate out to the 2024 projection, with the decreased NOI and continued increases in the cap rates, the value decrease becomes 57.7%. That's almost 60% lower in property value in less than 5 years. Just to interject here, there are 3 appraisal approaches to value they focus on: the cost approach, the income capitalization or income approach, and the sales comparison approach. Lenders worry primarily about the income and sales comparison approaches. The value of the income approach may fall 57%, but everybody expects the economic factors to be short-lived and things to improve again, so buyers and sellers of these properties may be willing to pay somewhat more than the 43% of the 2020 value that's reflected via the income approach. They may pay 60, 65%, or even a bit more with the expectation of the future income improving, so therefore the value improving. So that is why you're hearing about these anticipated 40% declines in commercial real estate. They know how this happened before, and they know it will likely happen again. Now you also know the financial mechanics at the property level of how this happened before and how it seems to be unfolding again. And with a Paul Harvey moment, now for the rest of the story that nobody else seems to mention. What about this inflation everybody is talking about? In 2007 through 2014, inflation really didn't hit the economy very hard. The government headline inflation averaged about 2% per year. So in theory, if rents were keeping up with inflation, then the asking rent per square foot shouldn't have remained the same, but it should have gone up. In reality, some expenses should have gone up as well, but let's not focus on the myopic just yet. Let's look at inflation since 2020 instead. We have a net inflation increase of more than 16% since 2020, and we are still at a 5% rate right now, with some property-centric additional increases like insurance costs forecasting to be well above average or well above the inflation rate over the next year or two. Extrapolating the gradual decline in inflation will continue into 2024. It's projected that the inflation latter half of 2024 will have been up about 24% or so cumulatively from the 2020 levels. That means that the income, expenses, and values should all have increased by almost 1/4. If many expenses have increased, then the asset value effectively declined far more in relative value than what the 40% decline in commercial real estate headline amount states on its face.
Hope you enjoyed that. Again, this is a forecast. Anything can change. Black swan events are always a risk. But there are some important things to recognize here. The first that I'd make note of is numbers do not lie. If they're objective numbers, but the people that are handling those numbers can do some really interesting things. How they contextualize those numbers, as you can see, they are using the same price per square foot, but they change things. So the numbers may not lie, but you have to have the real numbers. Second, the market is going to reflect the economic reality, and obviously we've experienced a lot of distortions in the market, whether it was the artificially low interest rates or whether it's the now increased interest rates, and how that impacts values. It skews the market. It distorts the market one way or the other because it is moving faster than the market inherently would organically. And so those distortions take time to work themselves out, but that eventually the market will reflect that. The third thing is the moving parts are all important here. You know, the rental income there's various reasons why it could go up or down. You could have a property that's completely leased, but the tenant's behind and they do a workout. So rather than lose a tenant, a lot of landlords will just, okay, we'll go ahead and write off some of that rent and that sort of thing. So that's collection losses. So there's that. There's obviously the cap rates that, as they were addressed in that video. Cap rates have already changed for a lot of property types in a lot of geographic areas, and they will continue to change. And typically, cap rates usually end up at least 1.5% or 2% higher than interest rates historically. And part of that is the fact that you have some risk, various other things. So they typically end up higher. Cap rates got really seemingly artificially low from a historical perspective in recent years, meaning values were abnormally high. And it was because interest rates were at zero, or if somebody was paying about 2.5% on a commercial mortgage, or 3% on a commercial mortgage, and they had a 3.5 or 4% cap rate, well, you were above the interest rate. Well, now if they're refinancing, they're going 6.5%. Cap rates at 5% won't work. They may move from, say, 4 to 5, but they'll end up having to move to 7 or 8. And that is a significant shift in value. So that's another area. And the last, of course, is vacancy, outright vacancy. Going into a recession, it's highly anticipated that vacancy will increase. As we've already seen with office properties, it's an issue. It could likely be an issue with retail and other property types as well. And the last thing I want to say on this adverse factors to the market is, this excludes anything that the lenders may have to do as far as their underwriting standards. There may be regulatory changes. There's actually news out there now that there are regulatory changes that are anticipated that will change what lenders are able to do. Whether it's matter that their ratios change, they can't loan as much as they had because these things have been changed from regulatory changes. And they may just inherently be more risk adverse. They'll be much more conservative, even though they have room in their portfolio. They still may not want to write as many loans or refinance for as much as they might have a few years ago, because whether that's a lower loan to value or maybe a different debt coverage ratio, meaning how much income and debt. There's a ratio called debt coverage ratio. And lastly, I want to make note of at least something positive here. So I wish I could, I wish I could be more positive, but property values went up a lot from 2019 to early 2022. And so if they didn't take out any additional debt, they may have had 60% loan to value. They may ended up at 45% loan to value. Property values can fall a bit, and they'll still be in a comfortable position to refinance, presuming other lending standards don't cause problems. So there's many properties that won't be upside down in a flat market or a market that's declined slightly, just simply because the fact that they have so much additional equity that they accumulated in a short period of time, because the market was distorted by a lot of factors. That won't be everybody, but it may mitigate some of the issues going forward. So lastly, so I shared this case study because I wanted to share something with real numbers, real analysis. I hear a lot of commentary out there, and sometimes people share conclusions or they don't, but a lot of what they call analysis is not analysis. It is just a little bit of sharing data they found, but there's no analysis involved in that. At least not enough to actually support many of the conclusions they assert. So I wanted to share something where you saw real analysis, where you saw how things really occurred during the last real estate cycle, so you kind of know where things may be or how things may be happening in the coming cycle. I thank you for tuning in today. Catch you next time.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them.
What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.